So just a quick word. We all know that MSMEs are the backbone of the ecosystem. They have a large contribution to the economy. They have a large contribution to the credit growth. But when it comes to fundraising, there's always a challenge for small and medium enterprises, MSMEs. So I'll just touch base upon few challenges that we regularly see. So first is the lack of knowledge about funding options. So everybody feels that the traditional options of working capital, term loan is aware, but a lot of new age and complex structures that are possible are not very much aware by the SMEs. Challenge typically from a debt perspective is that it is very it's mortgage driven. There is a collateral that is required, and that is usually a challenge or a bottleneck for a lot of MSMEs and SMEs. From an equity perspective, not many people know how to raise equity, how they need to be ready from an equity perspective. So we thought that over here we're going to touch upon certain factors which are important when an SME is wanting to go to raise equity. Of course, there can be a challenge if there's a distressed asset, distressed debt, then both debt and equity are challenging, but not impossible. We will touch upon that. And typically MSMEs and SMEs, we have seen that they have inhibition of letting go of the equity. And they're typically wanting debt structures due to that. This is something also. So these are the challenges which we have seen that are typically plaguing SMEs. So how do typically we raise funds from an SME perspective? Self-funding, very much the first one, where you have a limited corpus. You can do it, you start your own, but it may not be enough. Friends and family may or may not come to invest in your venture. Internal accruals come, but they come at a certain stage once you are making money, cash flows are there. So primary way to go is debt. Now, this could be for capital expenditure purposes or working capital purposes. But of course, there are certain issues and costs that come with that, which we will discuss as we go forward. And finally, the main one is outside equity. Now, outside equity brings in a lot of flexibility. There is a cost of funding is definitely higher than debt because of the risk involved. But typically, they don't come with any baggages of collateral or mortgage over there. But having said that, the investors do not see the project the way typical lenders see it. So we'll explain how a typical private equity investor would see the business. And over here, something which I have seen in my experience that investors are wary of is that they are afraid that the investors may start taking control of the decision-making process. So this is the inhibition that typically we have seen. But I think more than that, there are a lot of advantages that people bring over here. So before we dive into equity, I thought that let us quickly touch upon the traditional ways of funding from debt. We are all aware of lending from banks and NBFCs, which are the traditional way where there is it's a mortgage-backed system. Very rarely it's unsecured. Now, why I've written 11 to 30 is that, of course, there are those public sector banks which are giving away at typical 6 to 7% working capital rates. But the way fund wants to grow and you do not have enough collateral, then there are instruments in the Indian financial system at a higher cost from which you can raise money for fueling your growth. In terms of, it could be your special situations funds could be there, or there are special lenders who are ready to take risk, give you a better term sheet or structure than a traditional bank, but it comes at a cost. Usually these days, venture debts have come into the system where they are ready to give you money at a higher cost, lower conditions, easier repayment terms, may or may not be with collaterals. but because the risk is higher, typically it's high cost. Now, typically where I'm seeing venture debt is even in the startup ecosystem is very, very active, but they're very cash flow based. So they would look at your cash flows and structure the repayments based on your revenues and your cash flows. Third are bonds. You would have heard of bonds and debentures, but they're typically not a very common instrument used for MSMEs and SMEs, because these are highly governed instruments. You need to have a strong credit rating, and typically they're larger ticket size. So the investors also who are there in the financial institution, they would want a thoroughly studied and a well documented credit rating for which they would like to invest over here. And finally, we have certain fintech platforms you would have seen, heard, which are these days they're common for invoice discounting, for vendor payments, for supply chain. So they are also coming up pretty fast in the Indian financial ecosystem uh, from a perspective of working capital. What are the challenges? So if we all know the typical challenges are collateral is definitely one challenge. The most important risk that you carry is liquidation risk, because if you're not able to repay the money, the lender has the rights to take over your assets and recover their dues. That is one of the biggest ones. Collateral from a lender's SME's perspective is always a challenge in terms of scarcity, because you may only have a limited number of assets against which you could leverage. Uh, End use, yes, there's very strict governance on end use from a debt perspective, where if you're taking a short-term loan, you should not use it for long-term purposes. If you're taking a capital expenditure loan, you should not divert it for short-term working capital use. And these are covenants which the lenders are very, very strict upon. These are the points which typically would encourage, or I would encourage any SME to look at an equity perspective, because these challenges in terms of end use, collateral, liquidation risk are not there from an equity perspective. So let's now see that what is the let's deep dive into equity fundraising in India. So primarily, it's pretty simple. There is no secret sauce over here. An investor wanting superior returns looks at two things. One is high growth and high margins. So if any business has a potential for high growth in terms of their revenue, and high margins means that their profitability is very high, it would attract an investor. What are the factors which an investor would look at? Now, traditionally, what I would like you to look over here is that a lender typically doesn't look at all these into graver details as much an investor would look at from an equity perspective. Competitive landscape. So what are your growth prospects? So typically they would be looking at industries which are growing. So for example, today in the auto space, the IC engines are being said or being told that in the future it's EV or greener fuels. So you could see that a lot of investors are backing startups and corporates which are looking at new age technologies such as EV. Then strong product development in terms of, again, it would have to be because otherwise we don't want to be commoditized. So you'll have to do a lot of product development, and that is what is happening in areas like in the electronic EV space, component areas, sensors, electronics, battery management systems. A lot of things are being researched upon, and that should lead to a high entry barrier. Otherwise, the investor is worried that again it will become a commoditized business and my money will go down the drain, because if it's a commoditized business, it's not going to be high entry barrier. Industry outlook. Changing customer preferences is a classic example of global as well as Indian preferences of people are now looking at experimenting with EVs. Uh, Presence of disruptive technologies, you could definitely see that in the auto space. You could see EVs there, then hydrogen fuel cell. There's a lot of research. The government is backing a lot of new green technologies. And of course, what are the growth perspectives? So growth perspectives, the investor would look at domestic, where we are a very highly consumption driven economy, but there is a better export perspective, then definitely he or she would like to back you. Robust business model. Are you dependent on a single customer? But typically, for example, railways. Typically, if it's a railway as a customer, people are a little wary in terms of what would happen from an investor perspective. That what if my cash flows get stuck? Uh, so those are the kind of things which we need to take care of from a customer base, so that there is no concentration risk from a customer, single customer, or a couple of large customers, and if they go away, then the investor has a concern. Strong supply chain in terms of your back end. You were seeing that in India today, there's a lot of action in country is making its own supply chain for electronics, design, manufacturing, even in semiconductors. The government is making PLI schemes and other schemes to impress upon investors to invest into the growing semiconductor industry in India. And overall, they would want a stable and recurring cash flows, same as a lender would also want that all the above lead to stable cash flows. One of the most important and underrated area is the management team, because many a times the investor will take a call on the promoter and the promoter's team after having heard all the other segments over here that we've discussed. Ultimately, he takes a call on the management and the promoter. So something that is also, when we're approaching an investor, it is very, very important to showcase yourself personally in the manner that the investor is ready to take a bet on you. So quickly, how do we look at equity funding? How is it based? Early stage, what we call as startups, they're typically backed by friends, relatives, small investors, which we call as angel investors. But from an SME perspective, if you look at growth stage, it's typically private equity, where private equity is very, very important because they help you deleverage. That will be one of the major advantages, because your balance sheet has become slightly leveraged. You deleverage it, and then you can leverage it again. We'll discuss that in a little in the next slides. And more importantly, today the financial investor is not what it was a few decades ago. Now they are pretty active in the engaging themselves in the not day-to-day management, from a strategic approach, where they will open doors in their global connects in terms of customers, suppliers, anything that can take the top line up, or they can reduce costs. A private equity investor is willing to help. Third and final one is the SME IPO, which many of you would have heard of, that in today's day and age, both BSE and NSE are giving out, they have made their own SME formats, and we are seeing a substantial amount of money that is flowing into the Indian stock markets for SME IPOs. We'll discuss going forward what are the at what stage should one look at private equity, at what stage should look at an IPO. We'll come to that. So quickly, how is equity investment typically different from debt? So the first and foremost advantage is that there is no liquidity burden, because this is one of the critical factors where the clock keeps ticking on the repayment schedule in a debt format, but in an equity format, there is no pressure to repay. You can focus on growing the business. Network effect, as I mentioned, that one investor brings in more and more business in terms of bringing new customers or even vendors. Usually investors help you raise the follow-on rounds also, because now they have skin in the game. So they will want to protect their own investment, due to which they will ensure that the next round of fundings are also completed, and they extend their own network for that. Another very good reason for raising equity is primarily you don't need any collateral, as I had mentioned, and there is no liquidation risk from a equity perspective, because they're completely different formats, and unlike debt, there is no liquidation risk because you don't have, there is no repayment issue over here. It's there in certain structured formats like OCDs, optionable convertible debentures, but in a traditional equity, pure vanilla equity, there is no liquidation issue. So let us see now that, let us go through that. Is your business investable? So let us ask, and I would encourage yourself to ask this point to yourself, that if you are an SME, is your product innovative? What are the prospects for expansion? What we covered in the last slide, is your business model, does it have decent cash flows, supply chain? Is it leveraged appropriately? Industry outlook, very, very important. That is your industry a highly commoditized industry? Is it a sunrise industry? Is it a sunset industry? For example, I see internal combustion engine. There's a lot of rush in the IC space, especially for those components which are not going to go into the EV space. For example, your exhaust systems, they are not going to be there in the EV. So there are a lot of these players working on re-strategizing what next to do and how do we attract investors for the next phase of growth, else they will perish. And again, from a management team perspective, that what else do you have then from your day-to-day operations which will attract the investor? What are the succession plans? Are there any other level 2, 1 down professionals in the ecosystem that you have groomed? So I would encourage take a pause over here to see if you would look at these. Now, typically, the investor would not be interested in single digit, or nor is he interested in taking over control. So the sweet spot for an investor would be 15, 20, 25% because he gets a major minority. Which is there, and that's where he gets an active role. He would want a board seat. And remember, in India, as per Companies Act, for passing special resolutions, you need to have 74% over here. So one needs to discuss, hire experts in terms of all the accounting, legal, taxation angles to see what is the right offer that can be made to the equity investor. We'll come to that. So this is the $1 million question that I would like to ask all the SME founders or future founders, that are you willing to give up equity? Because I personally, when I started MergerDomo, I had 100% equity with me. So one of my earlier mentors told me, look, Hormazd, there is no point keeping 100% equity with zero value and keeping it over here that I have 100%, I'm the owner of something. You need to let go of certain equity if that is allowing you to create value. And we all know, and the case of Flipkart, promoters sale is very well known to everybody, that Sachin and Vinny became billionaires at the end of the day, but at the end of the day, they hardly had I think 1.5 to 2% each at the time when Flipkart was sold to Walmart. So that is the amount of wealth creation they did for themselves and for all the earlier round investors by giving equity, but fueling growth to that extent. So ultimately now, if we are looking at getting ready, or the promoter or the SME decides that, yes, let us look at funding, let us make a business plan to grow, let us go to the next phase, let us take our company to the next orbit, then you need to decide that for what are you going to raise the money for? How much do you need, first of all, and why do you need it? Is it for, you need to lay out some strategic goals, that am I going to enter a new market, or am I going to develop a new product? Am I going to do an acquisition? So I usually suggest the Ansov matrix. It's a 2x2 matrix. Igor Ansov was a Russian scientist, and he had made this 2x2 matrix. And if anybody is interested, it's freely available on the net. So the very first thing that the company needs to decide are that you define your goals. Then you start building your network. It's not a day's affair that you just make it and you call an investor and he's going to invest in you. It doesn't work that way. You need to understand what's going on in the industry. You need to network. You need to leverage your network in terms of possible investors, mentors, guides, to see what are the next areas, what is possible, where can we grow. Then you can start and thinking that, okay, let me make my uh, a pitch deck, which will first help me understand how I need to present to the investor. So at this stage, it's not for the investor, it is for yourself. And over here, you need to, it's a very well-crafted, short 10, 15 slide, 12 slides, if possible, highlighting the entire story of your company, past, present, and more importantly, the future. Again, the team management, I cannot underestimate the importance of the management that the investor is going to take a bet on. And of course, you need to have your financial plan ready. So the financial plan at this stage again would be for yourself, that let me make my project. We typically give lenders a very basic CME data, that for next year, what is your projection? That's very, very raw. If I were to say compared to a private equity investor, you will have to really, really get down to the nuts and bolts of every line item in your PNL and balance sheet. That will give you a very, very clear picture of, can you really go to the next orbit, and will you be able to attract investment? Once the pitch deck is ready, you are going to go to investors. You need to prepare for the due diligence. You should not ideally wait for the due diligence. So here I'm not saying that this is the DD stage. I'm saying prepare for the DD. Due diligence primarily is basically the investor is going to check that is your house in order. Simple. So if you're in the primary levers, he is going to check our financials, legal, operational, and today there's a lot of focus on ESG also. So these are the areas where you need to, and I would always advise that keep trusted advisors and experts on your side who are experts in these areas, and they would be able to help you and get your house in order. Then you need to also see and understand and learn that you have to ultimately start negotiations and closing the pitch, because it's not going to be an easy ride. There will be multiple back and forth, and more importantly, there will be a lot of technical terms which investors use regularly, but for you as an SME, you would not be aware of these terms. So take time out, and you can also start understanding. For example, there is a thing called tag along ride, drag along ride. What does it mean? So there'll be a lot of such terms which are very standard in a acquisition or investment document, but we should be aware of these things. So again, must work with legal counsels to understand how a term sheet would look like and what are the negotiation strategies. Hence, I would always advise go with investment bankers, tax advisors, accounting experts, and a legal counsel. These people would be very, very important by your side, and it would be very difficult to go on your own without them. So quickly, how do you craft the deck which I was talking about? There's no rocket science over here. You introduce yourself, your company, typical key milestones. What have you done in the past? Any major awards, any major contracts till now? What have you done? What is the core team? What is the core team strength? What are the products and services that's core to your business, which is your key selling point, that this is my USP? What is your growth strategy? Now you start telling him, hey, look, I'm here right now, but if I get the money, this is where I want to go. This is the go-to-market strategy that I'm going to use in terms of online, offline, domestic, international. So you need to start building. This will again give you a lot of clarity on how to take your company ahead. Your business model in terms of how do you actually operate? Is it a B2B? Is it a B2C? Do you have a large sales team? Do you have an online? Do you have offline sales? So on and so forth. You need to bring that down in your business model. This is very, very, very important. Competitive landscaping. Investors are wary of people who do not understand the market and they have not studied the market and they are talking through the hat. That really puts them off. So it is very, very important to understand the competitive landscape in terms of your domestic competition, in terms of your imports, in terms of your substitutes. So these are things, again, I would recommend the Porter's five forces model, very, very elementary. I think most of us have studied it at school. So you can always look at a Porter's model to make your competitive landscape. Historical financials. And then when your financial model is ready, you will know, and very, very importantly, you need to first know, okay, what is the basic valuation that I have, I can get, and funding requirement we know, but with the funding requirement will lead you to your dilution. Because once you know your valuation, so if you say your company's valuation is 100 and you want 20, then you need to give 20 rupees to the investor as pre-money valuation. So that gives you clarity, and that's where the ball sets rolling. And I mentioned that you will have to give your very, very near to your heart equity. So this whole homework will help you internally understand that this is the journey I'm going to go with the investor. Exit strategy, very, very important, because the investor would not be willing to invest in an unlisted company till he clearly knows his exit plan. Now, typically exit plans are three-pronged for an unlisted company. One is a buyback. So the promoter signs a buyback clause that at a given in the future date, I will buy back your equity, and there will be certain covenants in terms of EBITDA or revenue that would be achieved, and possibly a predetermined rate of return could also be agreed upon. So that's one. Secondly, you will have a strategic sale. So one investor will look out for a second investor, slightly larger investor, because investors also work in different phases of the growth: early, mid, large, bulge. So they also know that this investor can take. And third is the IPO. So you could go to the market, get listed, and all the existing investors can also take an exit with it. I'll just touch upon a brief point from a valuation perspective over here. That from a valuation is very, very important, and it is important that you start doing your homework before you go to the investor. There are multiple ways to do it, but I have highlighted two most important ways. Discounted cash flow is a very, very detailed analysis of your future projections, where you make your projections. And while this is very, very technical, what I have mentioned over here, simply what it says is that there is always a time value for money. So what we are going to see is we are going to discount all the future cash flows with this green color discounting factor. Discounting factor is nothing but what the investor is saying, that your cost of capital or the rate that I need minimum from you is say 20 to 25%. So I am going to discount all your future cash flows on time zero, that is today, at say 20 to 25%. So that concisely, that number which will come is called the valuation based on discounted cash flow. Now, again, if that number is 100 and you want to 20, so again, you want to give 20. But if the investor says, no, your valuation is only 40, and you need 20, so then he's going to ask you for 50% of the stake. So these number crunching activities will give you a clear idea that before I go to the investor, I know that this is my broad valuation, and if he tries to squeezes me, I know that he's squeezing me. Otherwise, I'm ready to sign between this much range. There are a lot of technicalities. This should be done by hiring a financial expert. There are a lot of people who, especially investment bankers, who are doing this day in and day out, because it is a part of their M&A and fundraising journey. So making a business model, financial model should be done with by a practicing investment banker. Chartered accountants can do it, But typically, I would recommend that if the chartered accountant is an active investment banker, better to go with that. Second one is a slightly quicker back of the envelope calculation, that what are other companies in your industry being valued at. So now these would typically be listed companies. So for example, if I'm in IT and I'm in IT, I want to benchmark myself. There would be large corps, there would be mid corps, and there would be SMEs. So if I'm an SME, I don't think I'll be able to say that, oh, TCS is getting a sale multiple of say 5 or a EBITDA multiple of say 25 or 30. It won't work. So again, you will have to work with a professional who will guide you step by step, that the market, which is the right market competitors for you in your space. So when revenue or EBITDA are the two main common feature metrics on which multiples are taken. So for, if I just give a quick example, uh, say you have say revenue of say 25 crores, and in the competition, the market, the listed companies are trading at market cap to sales of 1. So that means you will also use that 1 multiple on your revenue. So you will also, your valuation will be 25 multiplied by 1. So typically on a commoditized, not a very IP driven in India, 1 to 1.5 is what we have seen. It could go below 1 also as a sale multiple. EBITDA multiples for commodity are again very, very low, starting from 4, 5, and then they keep going up depending on how well your balance sheet and your P&L are shown. So these are the two broad ways. They should be worked in tandem. They should not be working opposite to each other. So this would give you a bird's eye view of your company's valuation. Now, as we are progressing the journey, the way we've structured this presentation is that we want to capture broader essence of each step of your future possible funding journey. So due diligence, as I mentioned earlier, is your report card for the investor. So let's keep them in 3 brackets. One is a financial due diligence, where anything and everything linked to your financial numbers, be it obviously the very obvious ones would be your audited financial statements. They could be 3 years, they could be 5 years. Somebody could ask for 10 years. Tax returns. Uh, there are a lot of your loan documents, your contracts, and they would also want to understand all your KPIs, that as a company, what all do you measure yourself on in terms of your revenue and profitability metrics. Legal due diligence, very, 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 very important. Please do not underestimate this. So all the standard documents like company incorporation and contracts would be very, very important. He would also like to see that how well documented you are in your own company. So your vendor contracts, your dealer contracts, IP, if any. Are you even looking at IP? Are you even working with a trademark or a copyrights agent? Today, it's not just about copywriting or trademark for your logo. Today, investors are also looking at, have you done a process patent? Have you done a product patent? And they would want to see in what depth you have done. If not, then you should go back and look at working with a IP legal counsel. Regulatory filings, very, very important, which your company secretary should ensure that everything is in order. And of course, this is going to be very, very critical, that are there any legal litigation history in terms of the company and or the directors of the company. Finally, the operational due diligence is how well are you running the company, is what they're going to check in terms of your org structure is there, sales and marketing is there, which they will deep dive over here, that how well or how are you organizing your sales team, marketing activities. And if it's a plant, then your operational shop floor level details are going to be at granularly checked. And these days, of course, you need to have your technology and systems documents also in place. So how do you do this? Yeah, this was one very interesting anecdote that I wanted to share. Last year we were doing an DD on the platform. The seller was a Gujarat-based auto ancillary, and the buyer was a North-based large investor. The term sheet was signed, the DD was being conducted, both sides hired fat-paying lawyers. Things were going good. One small thing came up that the plant did not have a fire NOC. So the seller said, over here there is not much issue. The fire department comes and goes, and yeah, but they have only not given any NOC. Investor said, no, 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 nothing doing. I need a fire NOC. So they said, no, it's not needed. 2-3 months just dragged like this. So finally, investors said, look, I need it, or I am a international investor. I cannot work without it. Then it came that another 50 lakhs has to be invested in it to upgrade the firefighting equipments. And who will pay for it? Another 3 months lingered on, that who will pay, who will pay. And by the end of 6 months, the investor had lost interest. And for a small amount or a seemingly small issue, the deal was called off. So I cannot undermine the importance of keeping our house in order in terms of the smallest of details which the investor can get put off by. So how do we prepare for all these things? As I mentioned, you must have a due diligence team. It could be a mix. It should be a mix of in-house as well as external consultants, experts, and do keep an eye on the environmental laws these days. If your plant has any effluent treatment or ETP, STP issues and all, again, do not undermine any of these issues. Preparing a data room since a long time is now, it's called VDRs, virtual data rooms are being made. So there are proper virtual data rooms one could pay, but those are quite expensive. And one are you can do it in a simple Google Drive and keep uploading one financial DD folder, one legal DD folder, one operational DD folder, or basically however the investor gives you a checklist, they will give you a checklist. You can prepare your DD room accordingly. And of course, communication, many a times in India, we have seen that communication is not kept open. And still there is a, this camp, blue side, red side, boxing rings are there. It should not be seen that way. It should be more of an open, friendly, warm communication. If there are challenges, they should be addressed and seen, yes, there is an issue, but this is how we will counter it, rather than trying to suppress these issues, which could cause issues later on in the DD, and the deal may be called off. So this we spoke of from a private equity investor point of view, that these are the typical steps that are taken. These days, what is happening is with the MSc, BSc IPO platforms that have come, the SME platforms, we are seeing a lot of action that is happening over there also. And a lot of corporates are willing to explore SME IPO. So we thought that let us quickly touch upon the SME IPO covenants that are clearly given by the stock exchanges. So first and foremost, you have a very standard checklist of your paid up capital, net worth, net tangible assets. I mean, it's clearly laid out, and this is very much available on the net also. And but what I wanted to highlight was that, of course, delays, there should not be any delays, because the investors over here are also ultimately institutional investors, retail investors. They will get put off if any of the issues are there in the company. So how do you go? You basically, you need to hire a merchant banker who makes a DRHP, that's a draft red herring prospectus. Typically takes anything between 3 to 6 months, could take 9 months, depending on the market volatility and conditions for taking the IPO ahead. What are the challenges for an IPO? Costs are quite high. These days, what we are getting to see is that anything between 6 to 10% of the round, or the IPO round fundraise size is the cost. Timing issues are very much there. It's a long drawn process, anything between 3 to 6 to 9 months, depending on SEBI giving them a go ahead, no go kind of things in the system. And they may it may go back and forth with SEBI. This is very, very important. You would have seen a lot of large startup who were backed by large investors wanted their exit. Some got, some didn't get. I won't take any names, but we have seen that if the market timing was right or wrong, a lot of those listed companies have gone down while it gave an investor the exit. But there are few companies who did not or were planning IPO later on. Many of them have still not got because of the volatility or the overpricing, overheatedness, or underheatedness of the market. Regulatory compliance, as I said, this again, the whole DD aspect that was there from a private equity investor will definitely be there over here, possibly more over here as well. And these are very, very time consuming and tricky. So it's very, very important to keep your house in order. Liquidity risk is there, but this is more from a shareholder point of view, because typically the trading volume depends on the trading volume for each company. If the trading volume is good, then after the lock-in period of the promoters, they can also exit, partly exit, and the retail investors can also exit. So let's look at, now we have given you an idea of both private equity as well as IPO. So the natural question is that what is the next logical way of looking at it and what to approach? So clearly there is no right formula for that, but clearly I can mention that typically a private equity investor precedes the IPO funding, because if I were to look at these numbers, not every SME today or MSME would be at this number. So clearly that the SME or the MSME who's looking at raising funds, if these numbers are not being achieved, he would not. But having said that, an SME investor, the private equity investor, if there is a growth story, he can definitely look at. So we made a three scenarios over here, that if you're a company which is into high growth, moderate EBITDA, it is possibly good to go for a private equity, because over here he will be bringing in not only the funds, but a lot of, as I mentioned earlier, his whole network over here. So he will help you grow domestically exports, and also there will not be that pressure of public markets on you. So you can focus on your growing the business. If you're slightly up the curve now, you're slightly well established, high to stable EBITDAs, yet you want to grow, then definitely IPO is a good area. Your debt equity ratio is in place. So it's a good time to go for IPO, because there you can give an exit to your existing investors and plan your future growth also. If you're growing rapidly, you have very high debt because you have fueled your growth from debt, then your private equity is a good idea. Why? Because you will be able to deleverage your balance sheet and grow with the equity money, improve cash flows, and then possibly again re-leverage. So that is a way strategy which one needs to mix. Again, there is no right on wrong. There is a bit of overlap, but a PE is good to get into a PE mode if you're at a slightly early stage. So that's where we wanted to, this was our first level presentation, where we thought that in the next webinars, we're going to touch upon and get into deeper on each of these fundraising aspects. So as a platform, we are right from the thinking stage that I want to sell my business, I want to prepare my documents, I want to know my valuation. Now I'm ready with my valuation, I've made my information memorandum, now I want to go for fundraising. So all these things are very, very actively done on our platform. I would invite all of you to read our blogs, read our educational videos on fundraising. Each nuances of fundraising has a different YouTube video. We do a lot of blogs on that, and we also have a very interesting tools where you can check your own valuation. You can prepare your own deal summary for investors, which will again be a good knowledge base for yourself, that how well prepared are you at that stage. So that's what I would invite the audience, that do take a look at our website and see where you are, at which stage. Are you at the thinking stage? Are you at the deciding stage? Are you at the ready stage? And at each stage, we can either help you prepare or connect you with the right set of, as I mentioned, legal, tax, investment bankers. And if you're completely ready, then you can definitely, come on the platform as a seller, fund seeker. And everything on our platform is on a completely no-name basis. And with over, we have over 700 investment bankers, strong 400 plus investors, which are typically your large family offices, private equity funds looking for investment opportunity like yours. So we'll be doing a quick giveaway. In terms of whatever we've covered, we'll be giving away a guide for your fundraising information memorandum templates, as well as a due diligence checklist. So I will be sharing a feedback link in the chat box soon. And once you fill it, we will share all these resources to everybody via email. So I'll stop over here, and I will thank everybody who is there uh, for everybody's time. And if there are any questions, I would be happy to take up if there are any questions. Yeah, so my colleague Parth has put in the uh, over here. Yeah, so thank you, Varun. Varun is saying very informative session. Thank you. Viren, you are asking any inputs on the IT health tech scene. I'm not sure what you, anything specific we can do a one-on-one. I'll write down my mobile number over here. You feel free to contact me directly. We can always, give more detailed understanding of what you're asking. So I think just one more minute, and once we fill in the feedback form, Parth, my colleague, will be sending it. Yeah, sure. That's my email ID. Please reach out to me for any proposal, or we typically focus on companies which have a revenue of at least 4 to 5 crores, early stage, pre-revenue stage. We are not able to take up simply for the reason that the investors that are there on the platform are looking at slightly sizable investment opportunities, since we are not an angel platform. Anita is asking about construction materials and interiors under one roof. We are looking for pre-investment funding. So Anita, why don't you please reach out to us on a one-on-one? If the case is doable from a size perspective or story perspective, we definitely want to work with you. Any other questions? So I have given my mobile number, Anita, over here in the chat box. Okay. So once again, I'll thank my audience for the time. Going forward, we'll be making more webinars for getting into detailed analysis of each of these points. If there is any particular item which you would want us to work upon for the next webinars, do reach out to us and we'll consider that. so that it makes it more informative. Okay, so thank you everybody. I'll stop the recording here.